Welcome to TalkTickers. This is the Deep Dive. Today, we're diving into Gevo Incorporated's first quarter 2025 earnings call. Our goal here is to unpack all that info, pull out the critical pieces, the key data, so you get the core message fast.
Exactly. We've gone through the summary, and it's an interesting quarter. Some expected numbers, sure, integration costs and all that. But the real story, the one management's telling, is about momentum in the operations and some pretty strategic moves happening.
Okay, let's start right there with the results snapshot. Q1 2025. What were the top line figures?
All right. Total revenue was $29 million for the quarter. But the key thing, and you got to remember this, that figure only includes 2 months from their big new asset, the Gevo North Dakota site.
Ah, right. February and March only.
Yep. So not the full quarter's impact from that facility yet.
Okay. And how about cash? Where did they land?
Pretty strong position. They ended Q1 with $135 million in cash equivalents, and restricted cash. So quite a bit of dry powder.
Good. Let's drill down a bit. The RNG subsidiary, how did that perform?
That brought in $5.7 million in revenue, which was actually an increase year over year, mostly driven by generating more LCFS credits, California low carbon fuel standard stuff.
Okay.
They got a better carbon score, which helps. But that was offset a bit by lower prices for the actual RNG.
Right, a common theme lately. And the new North Dakota site. For just those 2 months.
Yeah, for Feb and March, Gevo North Dakota had income from operations of $500,000, $1.5 million. And adjusted EBITDA was $1.8 million.
Okay, and the Gevo RNG segment for the whole quarter?
Also solid operationally.
Yeah.
$1.1 million in income from operations and adjusted EBITDA of $2.7 million.
Now, this is crucial, isn't it? These segment results, the positive ones we just mentioned, they don't yet have the impact of the 45Z tax credit baked in.
Not at all. That's the big one they expect to start seeing later this year. So what you're seeing now is kind of the baseline performance before that kicks in.
Okay. So on the flip side, there are still costs associated with growth, right? R&D, project development, that alcohol to jet work.
Absolutely. The combined net loss from operations for the segments doing that future stuff, Gevo and Gevo Fuel, was $21.7 million. Right. And the adjusted EBITDA loss there was $19.9 million. So significant investment still happening.
So bringing it all together, the company-wide consolidated picture.
Consolidated loss from operations was $20.1 million.
Right.
And the non-GAAP adjusted EBITDA loss came in at $15.4 million for the quarter.
So definitely a mixed bag. You see the operating parts starting to contribute positively, which is good momentum.
Exactly. Especially with North Dakota only partly in. But the R&D and development spend is still weighing on the overall bottom line. Management's message, though, was clear. They expect that operating momentum plus 45Z to drive them toward consolidated profitability this year.
Okay, let's dig into that path forward, the deep dive. That North Dakota acquisition, clearly a cornerstone. Why is it so strategic?
Well, it's not just adding another plant. It's about integration, building a platform for growth. And they said integration is moving along well. And importantly, the plant itself ran really well in Feb and March. Over 11 million gallons of low-carbon ethanol produced.
Impressive for just 2 months under their belt.
Yeah, and they sold the co-products too. Animal feed, corn oil. Yield was strong, around 2.9 gallons per bushel. That's a good efficiency number.
And the carbon capture aspect there, that seems like maybe the biggest part of the story.
Oh, it's huge. Central to everything. In just those 2 months, they captured and sequestered 29,000 metric tons of CO2 right there on site.
Wow.
And they estimate the ethanol's carbon intensity, the CI score using the specific model for 45Z, is around 21.
Which is very low, right?
Extremely low for corn ethanol. It means that fuel avoided about 7,000 metric tons of CO2 emissions compared to regular gasoline in Q1, just from its use.
And the well itself, the place they're putting the CO2, management seemed pretty excited about that.
They really did. They highlighted it as potentially one of the best sequestration sites, geologically speaking, in the whole country. The structure, its size, and critically, it's certified as a 1,000-year well.
1,000 years, that's durability.
Exactly. And they own it vertically. Full control from surface to storage. That geology and control, they see that as a major competitive edge.
Okay, let's pivot to the carbon credits then. Monetizing that 45Z credit, this sounds like the real catalyst for the P&L this year.
It absolutely is. They presented it as the key driver to get to consolidated EBITDA positive. Big news is they got the IRS Form 637 approvals needed.
That's the green light to actually generate the credit.
That's the one.
Yeah.
So they're anticipating finalizing the first sales agreements for those 45Z credits this quarter, Q2, and you should start seeing the benefits hit the income statement next quarter, Q3, and flowing through the rest of the year.
And they feel they're uniquely positioned for 45Z right now.
That's what they said. They believe they're one of only 2 ethanol plants currently set up to benefit from 45Z as it stands. Why? Because that CI score, around 20 or 21, is already so low before you even consider any potential extra benefits from, say, sustainable farming practices upstream.
Which might come later in rule updates.
Possibly. But they have a head start just based on their operational efficiency and the CCS.
What about the RNG side for 45Z?
Good question. The JVO RNG site produced about 80,000 MMBtus in the quarter, and its CI score is incredibly low, negative 339. So carbon negative.
Minus 339. Wow.
Yeah. They also expect to monetize biogas 45Z credits from that operation this year, too. So you combine the ethanol CCS for 2 months, the RNG for the full quarter. They generated over 100,000 metric tons of carbon abatement in Q1 alone.
Management also mentioned some positive legislative signs around 45Z.
Yeah, that came up in Q&A. Things like potentially extending the credit to 2031, which is longer than they'd planned for, and maybe the biggest one for corn ethanol. Talk about removing the indirect land use change, the ILUC penalty, from the CI calculation.
That's been a controversial factor, hasn't it?
It has. Removing it would be a big boost for corn ethanol scores across the board. They see this policy shift as supporting domestic industry. Plus, adding a clear pathway for dairy RNG was also seen as very positive for their existing RNG business.
Okay, let's switch to alcohol to jet, ATJ. That's the longer term, big growth story. What's the latest there?
They're definitely pushing forward, evaluating opportunities, but importantly, they've made real progress engineering an ATJ plan, specifically for the North Dakota site.
Leveraging their previous work.
Exactly. Using the ATJ 60 design from their South Dakota project. It's copy-paste approach, basically, to save time and money on the North Dakota build-out.
But they also floated a different idea, an ATJ 30, a smaller plant.
Right. This shows some flexibility. An ATJ 30 would be 30 million gallons a year, half the size of the original ATJ 60 concept. The thinking is it's smaller, more modular, so potentially faster to build, get it up and running sooner.
And cheaper.
Lower capital costs, yeah. And maximizing that modular build approach helps reduce risk, and especially on-site labor costs, which can balloon on big projects. It looks like a potentially quicker, less capital-heavy route to getting ATJ online.
Makes sense. So what's the status of the original ATJ 60 project in South Dakota then? Is that on hold?
The DOE loan commitment is still there, but management flagged they're waiting on some DOE resources and clarity, especially around the Summit pipeline connection needed for that site. JVO is also tweaking some offtake deals to meet DOE rules. So bottom line, they've dialed back the capital spend on ATJ 60 for now.
Shifting resources to the ATJ 30.
Seems that way. Focusing on developing the ATJ 30 at North Dakota. It's that adaptability again. They also threw in that they've got interest from companies internationally looking to use their designs.
Okay, now this part really caught my ear. The commercial progress beyond just fuel and federal credits. Voluntary carbon markets, unique offtake deals.
Yes, this is potentially a really significant layer of value. They're actively selling voluntary carbon abatement totally separate from LCFS or 45Z. Specifically, that North Dakota CCS operation is generating durable carbon dioxide removal credits, CDRs. That's for CO2 permanently locked away.
And they're building on what the previous owners started.
Right. Apparently that plant was the first ethanol facility to list CDRs on a public registry and even made some initial sales. JVO is now looking to really expand that.
And they announced a deal with Future Energy Global, FEG.
Yeah, that was interesting. FEG is buying the Scope 1 and Scope 3 emissions credits linked to 10 million gallons a year of future ATJ production.
Scope 1 being JVO's direct emissions, Scope 3 being the emissions from the fuel being used down the line.
Correct. And the key point here is the price FEG is paying for these carbon attributes is on top of the fuel value and any other credits.
So stacking value streams.
Exactly. They called it a unique book and claim system. Adds flexibility for buyers like airlines needing those emissions reductions. They see it as a market accelerator.
Did they give any sense of the value they're getting for those voluntary carbon attributes?
They did. They said the value is well north of $100 a ton.
Well, north of $100 a ton, that's significant.
It really is. A potentially very high value stream. And they noted that with recent deals like this, about half of the potential ATJ capacity they're planning at North Dakota is already spoken for, one way or another. And just touching on their global ATJ plans, they don't intend to own 100% of everything. They'll be Developers, licensors, strategic partners, they feel they have the intellectual property, the engineering playbook, the commercial setup, and this Verity tracking system to make that happen.
Right, Verity. Tell us a bit more about that platform. What does it do?
So Verity is their system for tracking and tracing the whole life cycle. Land use, farming practices, the carbon footprint of the crops, the energy used in the plants, all of it. It's designed to be auditable, science-based. Management stressed how important this is going forward, providing real data, pushing back against, narratives about land use or food versus fuel.
Showing you can do both.
Basically, yeah. Demonstrating that producing energy and food together using these low-carbon methods is actually better for the world, better for economic development. It provides that traceable proof.
Okay, let's pull back and put this in context for investors. How should you interpret Q1 and all this commentary?
I think the main message management wanted to convey is, look, the operating businesses, North Dakota Ethanol CCS and RNG, they're working well, showing positive momentum. That's the foundation. And they clearly see that North Dakota acquisition as the absolute key driver to hitting their target of consolidated EBITDA positive this year.
And the trigger for that profitability is the 45Z monetization.
That's positioned as the critical factor. Expected to start contributing next quarter, Q3, and really ramp up through the year. That's the linchpin for hitting the EBITDA positive goal in 2025.
And that strategic shift, pausing ATJ 60 spending to focus on the smaller ATJ 30 at North Dakota, what's the signal there?
It signals they're willing to be flexible, adapt to conditions, find faster, probably cheaper, and definitely de-risked ways to get their ATJ tech deployed by using the assets they already have online.
Not waiting for perfect conditions on the bigger project.
Seems like it. Pursuing a quicker win with the ATJ 30, leveraging North Dakota. Management also kept emphasizing the huge market need for jet fuel in the U.S. and their belief that ATJ is the best economic way to meet it. That positions ATJ as the big future growth engine.
And the voluntary carbon stuff, though, well north of $100 a ton?
That highlights potential value the market might be overlooking. It's not just about fuel gallons anymore. If they can scale those high-value durable carbon removal credits from that unique North Dakota well, that's a whole different kind of revenue stream.
A potentially very valuable one.
Potentially, yes. And finally, those legislative tailwinds they mentioned for 45Z, the extension, ILUC removal possibility, the dairy pathway, those are all framed as positives, reinforcing their current strategy and future plans. They also express confidence in their financial footing, aiming for self-sufficiency from operations for ongoing business, reducing reliance on outside cash, though big new projects will still need capital.
All right, it's time for our not financial advice segment. Remember, this is where we toss out an outrageous but plausible trade idea based purely on the info discussed. Absolutely not financial advice, just food for thought.
Got it. So the idea, outrageous but maybe plausible, is this. The market might be valuing JVO mostly like a traditional fuel producer, based on gallons, be it as standard multiples. But maybe the truly unique, undervalued asset here is that incredible carbon sequestration well in North Dakota, certified for 1,000 years, company-owned.
And they're already proving they can generate serious cash from it with those durable carbon removal credits selling for well north of $100 a ton in that growing voluntary market.
Precisely. So the trade idea is, go long JVO. The bet is that the market eventually re-rates the stock, not based on fuel, but based on recognizing the massive long-term value of that unique geological asset and the high-value CDR revenue stream it enables. The outrageous part, valuing JVO primarily as a carbon capture and removal leader. Their fuel operations become the engine generating the CO2 feedstock for this incredibly valuable 1,000-year sequestration asset. You project future value based on scaling up that CDR monetization.
A different lens entirely. Okay, wrapping up our deep dive on JVO's Q1 call, key takeaways from management backed by some numbers, positive operational momentum, a clear path towards profitability this year driven by 45Z, smart strategic flexibility on ATJ, and really exciting potential in those carbon markets and global plans.
Yeah, they definitely painted 2025 as a transformational year, feeling like the pieces are developed and ready to deploy now.
And just to reiterate, this summary is purely informational, not financial advice. We definitely encourage you to think about the implications of their strategy, especially that blend of low-carbon fuels and durable carbon removal. That North Dakota site seems unique. Keep doing your own research.
Thanks for joining us for this deep dive.